Hello everybody, it's Stephen again and I'm here today for the 7th video in this series. I hope you've been enjoying my videos recently and I've got another cracker for you today. So recently I've been crowdsourcing questions from the Etoro community, and the question that came up time and time again is, when should I take profit? So today I thought I would tackle that subject in a video. So I'm not going to be able to give you a magic formula or a ratio of when the best time is to take profits. A lot of this is up to you. But what I can do is I can break down some of the fundamental reasons why you would consider taking profits in the first place. It's often considered, when looking at the world's top 5% investors, how do they differentiate themselves from the other 95%? A common answer you will hear is they have the distinct ability to be able to let their winners run and cut their losers fast. Let's face it, when we do due diligence on a stock, we are quite confident that they're all going to perform well. But actually, in reality, it is most likely that we're going to get the majority of our gains from the top couple performers in our portfolio. So let's take an example of that. If you were to buy Amazon 15 years ago, you would have done extremely well for yourself. But many times over that period, there would have been ups and downs and times where you would have considered completely cutting your position. This would have been disastrous to your portfolio as a whole. So I want to give you 5 strategies and guidelines on when you might start to consider taking profit on a high-performing stock. The first area you need to consider when deciding whether to take profit off the stock is whether the fundamentals of that business has changed since you did the due diligence and decided to buy the stock. When I talk about the changes and those fundamental changes, what I'm talking about is not small short-term issues that can be fixed over time. What I'm talking about is changes that make it very improbable that the business is going to thrive in the long term. So we could be talking about things such as profitability. Is the business much less profitable than it was in the past? And is it very difficult to make it profitable again? Is the growth of the company starting to reduce? And is there a lot of new competitors which are cannibalizing our business? Or are there any regulations that may have changed that may stop the company functioning effectively? Or are there any changes to customer habits? Or is there any new emerging technology that may leave your product or service redundant? All these fundamental changes can make a real difference in the future prospects of the business. The second key point is the valuation of the company. Has the stock become much more expensive compared to its peers? There will often be many scenarios where the stock deserves to have a higher price than these other competitors. But if the fundamentals of the business are not too different from the competitors and the value of that company is much more expensive compared with its competitors, and it has a much higher PE ratio, it may be time to decide to start to take some profit. The third area you want to consider is if your asset becomes too high of a percentage weightage of your portfolio. This is an extremely nice situation to happen because it actually means that your asset has been increasing in value over time. But this also comes with its challenges, as it can increase the percentage weightage of that asset in your portfolio. This means that if there's a prolonged dip in that particular stock, or if the market goes down, this can have a negative effect on your portfolio. Often in these cases, what you want to do is you want to trim that stock at an area of strength to be able to reduce the weightage of that stock in your portfolio, and therefore leave the rest to ride for the good times. The fourth area you want to consider is there a better investment opportunity on the horizon than the stock that you're currently invested in? In order to be able to analyze this, you will need to look at something called opportunity cost. You will need to weigh up both options of which stocks to invest in and decide which one has the best upside potential. But be very careful when doing this and make sure you have a lot of conviction, because you don't want to be cutting a long-term winner. The fifth and final area you'll want to consider as has your asset surpassed your original plans on when you wanted to take profit? It's very easy to get caught up in the emotion of everything and either not take profit or take profit too early. You can set up key profit exit zones before you make a trade so you can take emotion off the table. I hope this video was useful for you all and helped arm you with knowledge that will help you in your future investment decisions. I thank you all for listening to this video and all of your support recently. As usual, if you have any questions or any comments, please leave them below and let me know if there's any future topics that you want me to cover. Until then, thank you everybody and safe investing.